Let's start by having an overall view of the recent reporting season. So, Ray, what are your key takeaways from the recent reporting season, and how does this picture the Australian share market moving forward to the rest of 2021?
Great, thanks, Paul. I guess if you want to start with the first takeaway from the reporting season, it was both domestic and globally stocks. You saw the economies and businesses stage a rapid recovery. What we saw was a pretty sharp snapback in revenue and earnings growth for most companies in the second half of the year. In fact, it was actually a very strong second half reporting season where about 44% of companies beat elevated expectations and a historically sort of low 13% missed expectations. The second thing we saw was the market tended to reward longer-term revenue growth narratives. So for example, companies such as WiseTech, Hub24, Domino's and Lovisa all gave strong trading updates and narratives around sort of longer-term revenue growth targets, which led to the market to re-rate these stocks pretty aggressively with little consideration to valuations. In fact, companies that generally sort of beat on revenue expectations were the ones that outperformed the most. If we look at reporting season, we can bucket stocks into sort of two groups. So as I said, one bucket was the domestic sort of based companies, and then the second bucket was Australian listed companies that are more global. What we saw for the domestic based companies was strong results, but overshadowed by quite uncertain outlooks. And that's just due to the hard lockdowns in New South Wales and Victoria and closed borders. Actually, most companies refrain from giving guidance. And for context, Morgan Stanley does this sort of informatic piece of research where they scan outlook commentary, and they saw a 2.5 times jump in references to market headwinds from these sort of domestic based companies relative to sort of previous periods. If you look at sort of the Australian-based, international, global-based companies, mainly sort of materials and cyclicals, healthcare and technology, these companies all reported pretty strong results, and most companies called out elevated levels of demand, but with some increasing inflation headwinds and some disruptions to sort of COVID supply chains. For the rest of 2021, how we're seeing, I guess, the picture for Australian equities. We're certainly expecting lockdowns to have an impact on particularly consumer discretionary exposed. It's pretty clear that the September quarter is going to contract by a few percent from the economic perspective, because what we're seeing and hearing from companies is government support payments aren't offsetting sort of lost income from lockdowns. But the way we are thinking about the portfolio is a little bit different. We think Australia is 6 months behind the rest of the world. So if you sort of look towards the impact of the second half lockdown, we think it'll be temporary. And you just need to look at sort of the US and the UK and look at mobility rates, which are now sort of pre-COVID levels, with most developed countries experiencing a strong recovery in economies. Our take is that once Australia gets a 70% vaccination rates, we think restrictions will be gradually lifted. There's pretty strong evidence that vaccination is reducing hospitalisation and death rates compared to non-vaccinated. We think the governments in Australia will move away from sort of zero case transmission targets and sort of adjust to live with the world with COVID and focusing on hospitalisation rates. And following from this, we think the government's likely to embark on productive sort of stimulus such as infrastructure programs, not forgetting that 2022 is an election year. So the portfolio and the way we're looking at the markets going forward, we are tilted towards cyclical and materials, and we are underweight consumer discretionary stocks and overweight industrials. And that's because we think second half impact of lockdowns will be sort of short. The market will look through it. The focus will quickly turn to sort of earnings growth and more pressure on inflation. And we think as inflation pressures start emerging from elevated levels of demand, it's a positive backdrop for materials and cyclicals. And we think sort of bond yields have sort of bottomed, and that augurs well for, I guess, the value end of the market.
The overall results that we've seen over the last month have been overall quite good. You've seen many companies, and what I've been looking at is so many companies have announced, oh, we're going to do a $2 billion buyback, special dividend. So you see companies have been holding onto capital and are now rewarding shareholders, especially with the ASX being so heavily weighted towards materials and banks, and with the commodity prices, which we'll touch on shortly, dividends and buybacks from very large companies such as BHP and CBA have rewarded many shareholders. And you touched on moving forward, the rest of 2021 is going to be scarred a little bit by the current lockdowns. And we also see that, and you don't have JobKeeper and JobSeeker at the moment, stimulating the economy, and there's other one-off payments from the government, but not to the magnitude of what JobKeeper and JobSeeker were. So I agree that consumer discretionary will not benefit as it did last year from all the stimulus provided by the government. And so, yeah, I agree with the majority of your takeaways from reporting season, and how this is going to transpire the ASX 200 for the rest of 2021. And what we will do, we'll have a look at reporting season now a bit more in depth, and let's touch on, so I mentioned out of the ASX 200, majority of those companies have probably reported earnings, half year, full year earnings now. So from what you've seen, which companies provided the most impressive and least impressive earnings reports so far?
Yeah, thanks, Paul. It would be remiss of me not to call out BHP and Rio, and even Fortescue, which reported its results yesterday. And so what you saw was the iron ore majors had basically more than a doubling in profits. And that was thanks to the iron ore price. So BHP generated about 20 billion of free cash flow this year, while Rio generated 10 billion just for the half year. And even though you've seen a sort of fall in the iron ore price recently, both BHP, Rio are on track to sort of deliver sort of 8 to sort of 11% sort of yield payout. You saw pretty strong dividends and special dividends return to shareholders from both Rio and BHP. And they've clearly stated to the market that they expect to be returning cash back to shareholders in the absence of organic and inorganic opportunities. And that's what shareholders saw in the last reporting season, is significant amounts of cash flow back. Some of the other strong results we saw in reporting season was the Australian media platforms, being sort of realestate.com.au, carsales and Seek, all recorded pretty strong results, benefiting from a recovery. But more importantly, these businesses also exercise quite significant pricing power. So for example, Seek in the second half grew its Australian-based revenue about 80%, of which 70% was price and product mix. Realestate.com, they grew their revenue by about 28%, of which most of it was volume and 4% sort of price. And carsales grew its revenue at a lower moderate amount, but increased price by about 4%. The banks and CBA did provide a result update to the market during reporting season. And what you saw with the banks is unwinding of provisions taken last year in anticipation of the impact of COVID. So what you've seen is more of a benign environment for bad and doubtful debts. A lot of that had been helped by deferrals of mortgages, effectively mandated by the government, which has helped the balance sheets quite significantly. And you actually saw improving net interest margins. And improvement in interest margins came from a number of things, such as pretty rational behaviour in sort of mortgages, but also benefiting from the Australian Term Funding Facility. On top of that, you saw the banks all announce capital management programs, handing cash back to shareholders. So overall, if you sort of look at the picture of results, a big snapback in earnings and revenue from the market, with, as you said, Paul, a lot of companies being flush with cash, having strong balance sheets, and shareholders are now benefiting from distributions and capital management programs. Paul, some of the worst results we saw really came out of, I guess, energy retailers and generation, such as Origin and AGL. What you saw with Origin and AGL was basically a collapse in electricity wholesale prices, which affected their generation earnings. And that's really led to the underperformance of the two stocks versus the ASX 200. They are suffering from low wholesale energy prices, and most of their generation capacity sits in coal and gas. And in the longer term, these businesses are also facing disruption from transition away from coal to renewable energy generation. So adding further woes to these companies is pretty highly levered balance sheets and ongoing restructuring charges. But it's not all doom and gloom for AGL and Origin. We do expect wholesale electricity prices will recover, particularly as the economy fully reopens. And there's increasing sort of shutdowns done on some of the older generational capacity. The companies are very leveraged to wholesale electricity prices. There is also some discussion around baseload capacity payments from the government, just due to coal and gas being baseload generation, which won't fluctuate with demand. Now, should this be enacted, actually, it could put a floor on coal generation assets valuation, as well as the earnings that these companies generate out of those generational assets. In the small cap space, there was probably two call outs there. First one was Kogan, well-known online e-commerce retailer. Delivered a very poor result, particularly in the second half. They burned through about $30 million of cash before acquisition payments. What they saw was ballooning inventories as consumer purchasing habits changed post the reopening of the economy. Also, they did suffer from supply chain disruptions and higher demurrage costs, which impacted their margins. But if you look at Kogan's result compared to other online e-com retailers such as Temple & Webster and Adore Beauty, Kogan clearly underperformed, and making matters worse for shareholders was management taking equity-based compensation of $50 million below the normalized result, despite a poor result. So that was one of the results which stuck out as quite poor. The other one in that small cap technology space was Appen. Appen provides data annotation services to large tech stocks such as Facebook, Google, Microsoft. Recorded a 2% decline to revenue, but a 14% miss on the earnings, largely due to cost pressures, margin mix. While 14% fall in earnings is not the end of the world, it was below market expectations. And what happened there was some of Appen's largest customers just reprioritized spending, which impacted its services. To be fair to Appen management, they've always been candid with the market to say that they've always got limited visibility in forecasting. It is a contractor to service-led business, but because Appen's been one of those market darlings in the past that's grown quite aggressively, its weak result was taken pretty badly by the market. And it also just highlights that the analysts have always struggled to forecast for this company.